100X show. We have the pleasure of being joined by Bancor, all the way from Tel Aviv. Welcome, Nate. Hi, Nate. How are you?
Hey, how's it going? Thanks for having me.
And welcome, Stefan. How are you?
Hi, very well. Thank you very much.
Okay, awesome. So, sorry, let me just get this ready here. So this is going out to both YouTube, Twitter, Periscope, Facebook, also gets turned into a podcast. We'll be taking questions specifically from Twitter. So let me drop the link into the chat and just give me a second. We have the pleasure of being able to give away free BNT tokens to the best questions. So whatever questions you have for Bancor, please ask them at this link that we'll be dropping in the chat. And the best questions will be getting tokens. So the way that will work is we'll be sending DMs to anybody on Twitter who has the best questions. Okay, so let me just post the link in the chat here. So go to that Twitter link. It's the Token Metrics Inc. Twitter. Just check the chat. I've posted the link. Go there, post the best questions, and we'll be asking your questions. Hey, Victor, how are you? Welcome to the stream. Yeah, so be sure to like the video, share with your friends, and subscribe. Okay, so I've posted the link. Let me know if anybody has any issues with the audio or with anything. Hey, Andrew, how are you? Hey, Maurice, welcome. What's up? If anybody has any issues with the audio or anything, just post in the comments and our team will look into it. Okay, so so I think let's begin with an overview on the project, because we definitely do have new people who maybe haven't put too much awareness into Bancor and want to learn more about what's happening with Bancor. So let's begin with quick introductions. So Nate, tell us about yourself.
Yeah, sure. So I head up growth at Bancor. I've been with the project since early 2018. Actually started my career as a financial journalist in New York for many years. Went back to school to learn how to code, moved out to San Francisco and started and sold a couple mobile internet companies, and then stumbled on Ethereum in about 2017, was trading tokens, just doing some trading, and stumbled on Bancor and realized that there weren't any order books on the site. So I was super interested in that, dug in a little deeper and realized there was this thing called automated market makers that was powering the system. So really went down the rabbit hole, reached out to the Bancor people, and became really obsessed with kind of automated market makers and decentralized liquidity. That was early 2018. And since then, we've seen really massive growth in AMM-based decentralized exchanges. So yeah, it's been a wild ride. Awesome.
Welcome. Stefan?
Yeah, so I have not been with the project for so long. I'm a banker consultant from background, so I used to be more blue chip area, but have been in the token space for a while, running a consultancy. And I joined Bancor as an advisor, especially on the V2.1, looking at the economics, the token economics, looking at the mechanism economics, because their new system is pretty interesting with this impermanent loss insurance, which is quite a cool feature. And I was writing the paper, the economics paper that went out with the project, which was quite interesting in the sense that way back, I used to do derivatives pricing and stuff, and I actually could use a lot of my derivatives pricing background in going in there, because ultimately this is an insurance, this is a derivative, and yeah, it is like a super advanced financial product that Bancor is putting out there.
All right, welcome. So how would you explain Bancor to somebody who's maybe not in crypto?
Wow. So I guess the real innovation of Bancor is, throughout time we've had asset exchanges, And these asset exchanges need liquidity in order to have trades be processed through order books. And traditionally, that liquidity is provided by the exchange or by professional market makers who typically run bots that buy and sell an asset. And in order to be a market maker on an exchange, you have to have quite a bit of money and quite a bit of sort of technical prowess. These are like the Goldman Sachs, the MIT PhDs who typically run professional kind of market making shops. Now, Bancor, once it came along, introduced an automated way to market make. So anyone who's holding any token can simply lock those tokens inside a smart contract that automatically buys and sells tokens along a sort of, we call it a bonding curve, but that really automatically prices the trades, and they can generate a fee from each one of those trades. So it's sort of similar to, I guess, staking a token or lending a token, but you're lending it to a exchange and extracting a fee from trades that occur in the token that you've provided to the exchange. So now I've realized that that explanation probably wouldn't make any sense to someone who's not in crypto.
No, I mean, it does. So I think at a high level, it's essentially peer-to-peer market making, right? So basically, yeah, go ahead, Stefan.
Yeah, so you essentially, as a liquidity provider, so Bancor offers a service to people who have tokens to put them in a liquidity pool, and the liquidity pool is then a market maker against which other people can trade. And Bancor was, if I understand, I believe, because I haven't been for so long, but they were really pretty much the first ones to get this thing up and going. But then one thing that people realized that there is an issue, and the issue is that, and it's an issue that normal market makers also have, is that if you make markets, you have to hold the assets, because, well, especially if you make markets with instantaneous delivery on the external market is a little bit different, because you might not have to hold the asset, because you might only have to deliver it 2 days later, and you might get it somewhere else from 2 days later. But we have instantaneous delivery here. And the only way that you can have instantaneous delivery is if you actually hold the asset. You have to hold both assets in the pool. And Bancor has quite an interesting system there that rather than having a pool for every cross, which can get very, very big, when you have 100 different assets that you want to trade, then you have essentially half times 100 times 99 different pools. So you have almost 5,000 pools that you need to trade every pool. Bancor trades everything against BNT. And this means if you trade 100 assets, you need 100 pools. So that's sort of the first point. But the second point is, you still, as a liquidity provider, you need to keep a certain balance of assets. And the way AMM does it, they keep the same dollar amount of assets in both pools. Now, this sounds nice, but the problem is what happens if one of the assets goes up, then one is going to be worth 110 and the other is still going to be 100. In order to keep the same dollar amount, you have to sell the asset that went up and buy the asset that didn't go up. And this means on the upside, you keep selling assets, and on the downside, you keep buying assets. And this means you're missing trends. Yeah, if you would just hodl, then if the one asset goes up, then, you just go up with the asset. But in an AMM pool, whenever the asset goes up a bit, you sell it, you sell it, you sell it, and you miss a rally. And the interesting thing about Bancor v2.1, and this is really sort of the core of what I've written about in the economics paper, is that this, what is referred to in a slightly bad terminology as impermanent loss, because it's often pretty permanent, that there is an impermanent loss insurance, if you so want. So to some extent, Bancor is a network. Bancor is a system, provides insurance for the liquidity provider against this impermanent loss. So there is an agreement, like an insurance agreement, that, look, you put these things in the pool, you earn your fees, and we provide you insurance that you don't have impermanent loss. And so this means that you can diversify your risk against these things, and then that you can still, with a hodl view, can still put things into a liquidity pool, which you could otherwise not do because you miss on every rally that there is.
Okay, great. So thank you for that, Stefan. That was definitely quite a very thorough overview. So for those who are just joining, I just posted in the comments, we'll be giving away free BNT tokens to the best questions being asked. So if you have any questions, go to the Twitter link in the comments and submit your questions. So we have the pleasure of having Stefan and Nate from Bancor giving us basically an update on the project and what's coming with version 2. So now I think it's time for us to kind of get into the weeds. So when DeFi was really blowing up earlier this year, and I kept on hearing about bonding curves, kept on hearing about AMMs, impermanent loss. I mean, you guys pretty much created DeFi, right? You guys were the kind of like the OGs of really going through and solving the issue of automated market makers. And now you're also working on something totally brand new on trying to solve impermanent loss, right? Basically, as you mentioned, people who could possibly lose money by having to hold 2 pairs. So now with Bancor V2, you essentially only have to hold 1 token, right? You have exposure to just 1 token. And you mentioned having insurance to that token. So could you kind of maybe go into further details into how that works, kind of like on a blockchain level and smart contract level?
Yeah, sure. So effectively, what we've done with Bancor V2.1, and like you said, it really tackles these 2 issues. The first is you don't have to have involuntary token exposure, and that you're not subject to this risk of impermanent loss. And I can sort of illustrate how those issues manifest themselves in the sort of old legacy AMMs that actually represent most of the market today. Now, let's say you were to go to Uniswap, which was effectively a fork of Bancor. They took the BNT token and ripped it out and just put in ETH. So say I want to provide liquidity on Uniswap to the Link pool, and I have my Link tokens, let's say $100 worth of Link tokens. When I provide liquidity to the Link pool on Uniswap, that's holds Link and Ethereum. Those are the 2 sort of paired assets. So I'll need to split my Link into both half Ethereum and half Link. So immediately I'm sort of losing my long position or my 100% exposure to Link. And like Stefan has described, if Link were to go up a lot in price, were to say Moon, I would be selling off my Link and accumulating ETH, the asset that's dropping in price. So I can really, even though Link is increasing in price, I can lose money versus simply holding the Link on its own. So what happens in Bancor or Bancor V2.1 is if I come with Link, let's say $100 worth of the Link token, the protocol will actually co-invest alongside me. So I come with $100 of Link and the protocol will deposit $100 worth of BNT on the other side of the pool. And so this allows me to really hold my 100% position on Link. And now during the staking period, the BNT that is provided by the protocol is generating swap fees in the same way that the user provided Link is on the other side of the pool. And when I decide, let's say the Link doubles in price and becomes $200 worth as opposed to $100, the protocol always owes me that $200 worth of link plus any swap fees that have been generated by the pool during the staking time. And
just to be clear, it doesn't owe you $200 worth of link. It owes you a certain link amount, whatever the amount of link was. Yeah, that's a fixed number. It's not the dollar amount that is fixed, but it's the number of link tokens that it owes you.
Right. So let's say I put in 10 link, it always owes me of the value of 10 link at the time I withdraw from the pool.
So I've actually pulled up a blog from Bancor as well. It kind of shows the visuals of how this works.
Yeah, sure. So what you're seeing in the visual is really the process of a liquidity provider losing money in the instance of impermanent loss, and an arbitrager rebalancing the pool such that the LP is left holding less of the assets versus if they had just held them in a wallet on their own. And so yeah, if you go over to there, and then I guess maybe scroll up, I think in this post a little bit,
this
you can sort of see how the elastic BNT supply is always compensating the LP for impermanent loss. So like I said, the protocol is providing the BNT to match the other side of the pool, right? And this BNT, like I said, is generating swap fees just like any user provided BNT or any user provided link. Each link trade that goes through the pool, a percentage of that trade is taken out of each trade and redeposited into the pool. So effectively, when the LP withdraws, let's say this link LP has suffered some impermanent loss on their stake, the fees that were generated by the protocol from the BNT that they provided, those fees are used to compensate the liquidity provider for any impermanent loss they've suffered. So the LP is guaranteed to get the full value of their initial stake back, plus any swap fees that they've generated on top of that value. And keep in mind, so a couple caveats. One is that the insurance accrues over time. So you can't just deposit and 2 days later pull out your tokens and always get compensated fully for any impermanent loss. The impermanent loss is a progressive model. So you have to be in the pool for at least 30 days in order to start utilizing the impermanent loss insurance. The insurance goes up 1% each day. So if you're in the pool for 30 days and pull out on day 31, you get 31% of your impermanent loss compensated by the protocol. And then if you're in the pool for 100 days, that qualifies you for full protection against impermanent loss. So any impermanent loss that's accrued in the first 100 days, anything that happens after that 100 days, you get fully compensated for the initial value of your stake. Now, keep in mind that part of the insurance can be paid out in BNT. So let's say, I had that 100 link in there, it doubles to $200. Then as I'm pulling out, if the pool has enough link in it to compensate fully for the impermanent loss, in link it will do so. But there may be an instance where, say, $170 is pulled out of the link, and then the $30 of compensation might come in BNT. So if a liquidity provider wants to, just trade that BNT instantly for their link to ensure that, they have that full value of link back, they can do so. But it's important to keep in mind that some of the insurance may be paid out in BNT. I just want to pause I know there was a lot of information, so just want to pause.
That was great. Great overview. Thank you for that.
Sure.
Okay, so I think let's now go ahead and take some questions from the audience. So once again, we're taking questions via Twitter. We posted the link in the comments. So just go straight to that link. And the best questions being asked will be sent free BNT tokens. So after the stream, give us up to a week, but basically Token Metrics will DM you, those who ask the best questions. So going through the list here, let me get one question from Tyler. Okay, so Tyler says, what is Bancor's vision for cross-chain swaps beyond what they've accomplished with EOS?
Yeah, so I could say really early on in the creation of Bancor, we didn't want to we realized the importance of functioning across blockchains, that while we would always be deploying initially on Ethereum and really perfecting the technology on Ethereum, that we needed to operate cross-chain. And this is where the BNT token is actually crucial. You can say, because you have a protocol token in every pair, unlike say using an asset like ETH in every pair, you can mint and destroy on certain chains in order to process cross-chain trades. So we built a cross-chain bridge pretty early on, just as a proof of concept, to the EOS blockchain. And now we'll be expanding that bridge to other chains in the near future. So we're in talks with chains like Polkadot and other chains where you'll be able to spin up BNT-based AMMs on say Polkadot, and have DOT tokens in each of those liquidity pools, and then be able to, in an atomic transaction, have the DOT tokens traded with ERC20 tokens using these bridges. So this was kind of a crucial design decision in having a common network token, BNT, in each one of the pairs. And it's really crucial in powering these cross-chain bridges, and going to be a big part of our sort of development cycles in Q1 2021. So stay tuned for some really exciting announcements and deployments of Bancor on other blockchains.
All right, thank you. Stefan, anything to add to that?
No, that's less my area.
Okay, all right. So be sure to smash the like button, subscribe, and share this video with your friends if you're enjoying the stream. Okay, let's go on to the next question. So here we had a question from, Daniel S. Lee on Twitter. Let me just bring it up real quick so everybody could see it. Okay, so thank you, Daniel, for asking the question. So the question is, please narrate the history of Bancor, including successes and failures, if they agree that Bancor has temporarily lagged behind compared to its peers, i.e. measured by TVL, total value locked. Explain why and how that happened from their perspective.
Yeah, so this is a great question, and I'm glad it was asked. Bancor made a very key design decision early on in its existence. So Bancor started in June 2017, and it's been around quite a while, right? So that key design decision that was made was to put BNT as its protocol token in every one of its pairs. So every one of its pools has the ERC20 token and BNT. And so this was a decision that in the short term introduced some more user friction, but we believe over the long term is really a key design decision that is offering currently more long-term benefits to liquidity providers. And let me break that down. So in the early days of Bancor and AMMs, like we've said, you had to provide 2 tokens in order to be a liquidity provider. And so if I wanted to be a part of the link pool in sort of the initial model of Bancor, I had to provide an equal value of link and an equal value of BNT in order to be a liquidity provider. And so what Uniswap came along and did is it, like I said, ripped out BNT and put ETH in the pool. So I could provide liquidity, and I can provide liquidity to Uniswap with half link and half ETH. And more users obviously have ETH in their wallet than they do BNT in their wallet. So to go to someone and say, hey, I know you want to provide liquidity and earn yield on your tokens and be a part of the network, but you have to acquire BNT first and then do it in equal and provide, that's kind of a more of a headache for someone who already has ETH in their wallet, most likely, and can just provide half ETH and half link to the pool. So this really, this reduction in sort of user friction really gave Uniswap massive traction. We saw a total explosion in Uniswap, let's say, towards the end of 2019 and into 2020, to the point where Uniswap is eclipsing at certain times even Coinbase in volume. And it was just this tiny sort of change, in the structure of Bancor to put in ETH instead of BNT. Now, something that is really starting to get noticed by a lot of liquidity providers is they enter the pool expecting to generate, this high APY off of, let's say, swap fees or off of yield farming rewards. But when they pull out their tokens at the end of the day, they find that they can actually be worth less than if they had just held them in their wallet. And actually, this issue in I'd say recent weeks and the past month has become even more noticeable with the ETH bull run, right? As ETH has gone up in price, a lot of Uniswap LPs have been getting totally wrecked. If you look at, say, like the Wi-Fi pool, the link pool, a lot of pools where you think as a liquidity provider, you're getting drawn in because of this high APY. But when one of the token moons, arbitrageurs just swoop in, extract value from the pools, and LP, you're just left holding less. So actually, we've seen this massive transfer of wealth from LPs who think they're making money to sophisticated ARBs, sophisticated traders who actually are really the ones who are making money. So when I say that there's this short-term or this kind of short-term benefit of having ETH, that's exactly it. By having BNT as the common token in every pool, Bancor can really manage liquidity in each one of its pools in order to provide this impermanent loss insurance, and also to allow LP to not be exposed to any other tokens in the pool, to only be exposed to one token. This is something that you couldn't do with ETH as the reserve asset. You can't control the supply of ETH as a decentralized protocol. You can't allow single token exposure if you have ETH as your token. So this really gets to the heart of the sort of debate over the value of having a protocol token. And I think BNT is really a textbook use case of why you need such a protocol token to really allow the protocol to manage the risk and diversify the risk of impermanent loss, such that it's not a single LP that's playing Russian roulette with their tokens, but it's a protocol that's really managing that risk and really reaping the rewards too of impermanent loss insurance through the fees it earns, and those fees are burned to reduce the supply of BNT. So that's really a long-winded way of saying there was a short-term change made by Uniswap that gave it a very big head start. And with V2.1, we've truly flipped it on its head. And the value of having a protocol token like BNT in the pools is really starting to shine. And so we're up to around 100 million in liquidity locked. I think Uniswap is now at something like 1.5 billion, but we think that liquidity is going to flow to Bancor pretty fast as more LPs realize that there's a huge risk of losing money on Uniswap, and this risk does no longer exist as an LP on Bancor.
All right, that's great. Thank you, Nate. Okay, let's go on to the next question from Twitter. So here's a question from Peter Bosco. Thank you for asking the question. Once again, if you have any, all questions being asked, we'll go through them and find the best questions, and we will give them free BNT tokens. Okay, so Peter says, do you plan to introduce a limit order feature for swaps in the near future? If yes, do you have a time frame for this implementation?
So the answer is definitely. Unfortunately, I can't give a specific time. We have a group of developers that's working on that. It's effectively building a sort of second layer on top of Bancor that will allow for limit orders. And I guess this is a good time to plug, if there are any pioneering developers out there that are interested in grants and working on this technology, this is a feature that we have folks building. We'd love to have them team up with any ecosystem developers. So any devs out there that want to accelerate some of these features on Bancor, we urge you to reach out to us on at Nate Hinman on Telegram or ping us on Twitter. And that can really help us get these features out even faster. But the short answer is yes. But we don't have a specific time frame of when it's coming. I'm hopeful of I guess the first quarter of next year, maybe Q2. But we definitely see this as a crucial feature.
Okay, all right. Thank you, Nate. Okay, here's next question. Okay, one of the disadvantages of the project is its complexity. Most end users find it hard to appreciate the benefits. How will Bancor be able to overcome this?
Maybe I can take this one.
Sure, go for it.
So I think Bancor it's obviously more complex, and the details of Bancor, the way it essentially works, is pretty complex, but all of this stuff is. And obviously when you have multiple pools and things are complex, valuing a company is complex, all these things are pretty complicated, so you need to take them back to a level where it gets easier. But at the core, Bancor is pretty easy. In the sense is that if you have an asset, you can either put it in a portfolio, have it sit there, or you can make it work. Making it work means there's two ways of making an asset work. You can either lend it to someone. This is like the banking business model. Yeah, you lend someone money, they do something with it, they give it back to you for interest. Or you have a trading business model where you say, look, I provide liquidity and I give you this asset and you make this asset work by making money. And so if you want to gain a yield on your asset, there are really only these two options. Now, Bancor offers one of these two options as a service. They don't offer lending, but they offer market making. So if you go with Bancor, you can earn money on your assets by market making. Now, Uniswap, etc., they also offer these things. But the difference between Bancor and Uniswap is essentially that, except in catastrophic cases, Bancor gives you an insurance. They say, look, the difference between Uniswap and Bancor is really, on Uniswap, you do say, hey, you need to choose two tokens, not only one. You say, okay, I want to provide liquidity in ETH versus Bitcoin, wrap Bitcoin, whatever. And then you choose those two tokens. And if they move against each other, you have an impermanent loss. There's just no way around it. And in the paper, I made actually a very interesting comparison. if you hold like 10 tokens, and often you have sort of the typical investment strategy for a token investor is, okay, I'm going to take 50 tokens. Most of them are going to go to 0 and one is going to moon. And if you have this one with assets that are in an AMM, you lose a lot of money because you're going to lose on all the tokens that are losing, and the one that is mooning, there you're not going to make any money. So that really doesn't work for that. And so Bancor offers you this service. It allows you to make money out of it whilst holding. Yeah, that's essentially the thing. But obviously, nothing in this world is free. You pay a little bit of the fees over to Bancor because this is how the network finances it. Yeah, the idea is that, look, overall, over the entire Bancor network, the trading fees will cover the impermanent loss. Sometimes on a single pool, there might be an issue. On one pool, if they diverge, there might be a massive impermanent loss, which wipes out all your fees and more. But the bet that Bancor is getting into, like any insurance company really, is saying, it's like, look, okay, on a single pool basis, there might be impermanent loss and it might wipe out all the fees. But across the entire network, if we diversify and if we share the risk of impermanent loss across the entire network, then this is fine. And so to some extent, there's an insurance premium paid, which is you pay away some of your fees, which is also just simply because you don't provide double-sided liquidity, because Bancor provides one side of liquidity. You provide one side of the liquidity only, but this still means you only earn part of the fees. And in return, you get impermanent loss insurance. And this is really all it is. You diversify. So Bancor at the core is an insurance company, or the Bancor network is an insurance company that allows you to diversify the risk of impermanent loss, whilst at the same time, and this in turn allows you to use your tokens that you want to hodl to make markets and to earn extra yield on them. That's really in a nutshell what it is. Yeah.
And I would just add to that, I mean, I think the best way to overcome the complexity of the underlying system, the answer is pretty simple. It's just to make liquidity providers shitloads of money. Make sure the APY, when they stake their tokens and when they pull them out, they're worth more. And there's this meme in DeFi, like, I'm here for the technology. It's sort of this joke that a lot of these like Deegans, so-called, don't really understand the system. They just understand like number go up, right? I put money into a smart contract when I can monitor, how much money I'm making. And then when I pull it out, I've, compounded my assets by a great deal. We refer to it as APY, or annual percentage yield, right? And it's, so that's really the sort of key to further adoption, is for LPs to realize that they're making very solid returns. And one catalyst for that recently has been the release of BNT liquidity mining rewards, which effectively BNT is being dropped on a weekly basis on a select group of pools. And this incentivizes LPs to provide liquidity to those pools. As more liquidity comes into the pools, they can process conversions with lower slippage and cheaper trades. So it'll attract more trades and more swap fees. So the LP who provides liquidity is both insured on their principal. They're receiving BNT liquidity mining rewards on a weekly basis, which, by the way, they can get bonuses for the longer they hold BNT in the pool. And then thirdly, are generating these swap fees. And so the APY, especially on the BNT side of the pool, can get pretty outrageous to, let's say, 300% to 500% annual percentage yield. So really, I think this is how we overcome the initial roadblock. And the complexity on the UX is really, there's really not that much complexity. It's just as easy as, a couple clicks, similar to just buying tokens. It just locks up your assets and we have a portfolio manager built directly into Bancor.network where you can monitor your returns. You can see both the returns from BNT rewards and the returns from swap fees. And I think really this is how we overcome the complexity of the underlying piping. We give Deegans what they want, which is more money.
All right. Not financial advice.
Not financial advice.
All right. Thank you. Okay. All right. So let's take a question from Twitter. I'm just going to read this off my phone here. So if Bancor is providing impermanent loss insurance, who is paying the premiums? In other words, where does the money come from that allows this compensation to be paid to liquidity providers?
Yeah, this is what I just alluded to. Yeah, that is that effectively it comes through the fees, that you get less fees because somehow the whole idea of generally of the AMM market making is that in the long run the fees outweigh your impermanent loss risk by hopefully a very, very big margin. And effectively the impermanent loss insurance is paid for by the fees. Yeah, that's really what it is at the moment, that the Bancor network takes part of the fees because also provides part of the liquidity on the BNT side. We have described this much more in the paper. I don't want to go in this detail here because it's a bit hard, but if there are yeah, this is, we have really discussed this in super detail if people want this, but it really comes from the fees.
And I guess what's also worth kind of adding to that is effectively what we've done with BNT with V2.1 is we've really turned it into a cash flow token. So in the protocol, like we've said, can co-invest on the other side of a pool to match single-sided deposits, generates fees off of the BNT that it co-invests. Some of those fees will be used to pay for impermanent loss insurance, which, by the way, this cost is only realized by the protocol when an LP withdraws from the pool and is owed some of this insurance. And then any excess fees that are generated are burned for BNT. So they reduce the supply of BNT and can sort of be considered, I guess, sort of a dividend to all BNT holders, because as the supply is reducing, you know, so it's really turned BNT into a cash flow token. We have also some governance, really interesting governance proposals that would allow the protocol to charge liquidity providers for impermanent loss insurance. And the fees that are generated from charging for this insurance, if governance decides to turn that switch on, could also be used as sort of perpetual burning mechanism for BNT, such that every swap that goes through the network, a portion of that swap is being burned for BNT and thus reducing its circulating supply. So, yeah.
All right. Well, thank you for that, Nate and Stefan. Definitely a great overview. So be sure to smash the like buttons if you're enjoying this live stream, and subscribe and share this with all your crypto family friends. Okay, all right. Let's take some other questions here. Okay, just give me 1 second. Whoops. Sorry, my computer is freezing. I got too many screens here.
Oh, good.
Okay, sorry. That is not what I'm trying to share. Sorry. Whoops. Okay, let's do that again. Apologies, everybody. The perks of doing it live. Okay, so here we are. Okay, so maybe we kind of do like rapid fire with the questions.
Sure.
Okay, so Ras Mantilla says, if we would like our insurance paid fully, in the original liquidity token provided. Is that possible?
So in some cases, the insurance could be paid fully in the original liquidity token. It really depends on how much of those tokens exist in the pool when you pull out. But in some cases, it will be paid out partially in BNT. And we are working with some developers on a mechanism whereby you get your, the token you provided, you get your insurance paid out in, and there could be an automated process for any BNT that's part of the insurance payouts could get automatically traded into the token that you provided. So I think that feature will be built pretty soon. But currently there is a chance that part of the payout of insurance would be in BNT. And also, just for your question right above, you say instead of there being a link ETH, it would be link BNT. That's correct. Every pool has BNT in it. But again, keep in mind when you're providing liquidity, it's just in link and you're just exposed to link. So you're not exposed to both BNT. And likewise, if you provide BNT to the pool, you're just exposed to BNT. You're protected against impermanent loss insurance. You're generating the swap fees. And actually, you're generating more of the BNT liquidity mining rewards, which can get pretty high if you're a BNT staker within those pools.
Okay, that's great. All right, next question. From Kenneth, is Bancor still a closed exchange in that the Bancor team chooses which tokens are listed? Also, I like the new UI, much better than the old one.
So Bancor was never a closed exchange. Anyone can list a token on Bancor simply by creating a liquidity pool for it. This has always been the case, and this was sort of part of the innovation of Bancor, is that the core functionality of an exchange was really automated by smart contracts. So again, anyone can simply go to Bancor.network, go to swap, then go to pool, then go to create a pool, and you can create a pool for any token, and that'll automatically go into the Bancor network, and that token will be tradable against any token that exists within the Bancor network, and anyone can then contribute liquidity to your pool and generate fees from swaps. And as liquidity goes up, like we've said, the conversions become cheaper and you're generating more returns. Now, something to keep in mind and to highlight is that with the release of the Bancor DAO and Bancor governance, the governance is deciding which tokens or which pools on the network are eligible for impermanent loss insurance and for single-sided exposure. So these are really key features that in some cases can cost BNT holders money. And so it's up to governance managed through the Bancor DAO, which I can sort of delve into how you become part of the Bancor DAO and a governance member. But governance is controlling which pools are added to the whitelist and which pools can be removed from the whitelist. And currently, I think there's about 60 pools or 60 tokens that are a part of the whitelist and that have impermanent loss insurance and single-sided exposure. And anyone can create a proposal that effectively asks Bancor governance if the token can be added to the whitelist. And so I wanted to add, in order to effectively vote in the Bancor DAO and to vote in Bancor governance, you have to be holding BNT. You provide BNT to a whitelisted pool, and in return, you receive VBNT, which allows you to propose new proposals in Bancor governance and also to vote on different proposals in Bancor governance. So that's how you would become really a member of the governance and vote on upgrades and new tokens that get added to the whitelist.
Okay, that's great. Anything to add to that, Stefan?
No, I think that's the key point, is that everyone can do a pool, but obviously because you mutualize the risk, there must be a governance around whose risk is going to be mutualized. And the single site staking is linked to the insurance, which is why you can only have those together.
Okay, so just pulled up the platform for everyone to see. This is Bancor.network. Go ahead, Nate.
Well, so I was going to add that we, in this initial phase, governance is being pretty particular about, what kind of tokens can get whitelisted, right? If you're an early stage token, you have it like you're brand new. It's kind of not sure if the token could, go crazy. There could be a rug pull. So, they're being a little particular right now about the sort of voting into tokens. But what's cool is we're releasing something that will actually create different tiers of insurance. So I think this is getting released in the next few days, but we'll have an insurance package that effectively lends itself to more long tail or early stage tokens, where maybe there'll be a limit where only a certain amount of insurance, up to a certain amount of insurance, could be paid out to liquidity providers, or only up to a certain amount of BNT can be co-invested to support single-sided liquidity provision. It's really in Bancor's DNA to support this kind of long tail, early stage token with instant liquidity that doesn't have immediate access to, say, the Binances or the Coinbases of the world with their massive sort of listing fees and listing processes. So anyone can create a pool on Bancor. You'll have access to the instant liquidity, but to get those sort of V2.1 features of single-sided exposure and permanent loss insurance, you may want to tap some of those custom insurance packages that are coming from the governance.
And how many people are in governance? Is that all token holders?
So it's how many BNT holders have staked inside a pool. I think it's around 5,000 protected positions now. So there's around 5,000 VBNT holders that can dictate how these proposals are passed or introduced. And we hope that number will just continue growing as more people acquire BNT and stake it in a pool to take advantage of these of the APY in this pool. And Ian, I want to actually take a pause. I'm curious from your perspective, like, are you, I know you have a background in sort of trading and you're pretty well known for that. Have you played in the DeFi ecosystem at all? Have you?
Yeah, so I guess my history, I was an investor in the Bancor ICO back in 2017.
Oh, okay.
BNT. Mainly I've been providing liquidity to pools on SushiSwap, Uniswap, yield farming, but just kind of more passively, not so active because we've kind of been busy building token metrics. But I think DeFi is definitely the future of finance, the future of crypto. Yeah. And it's very fascinating to see how people are developing so fast, right? And our team has actually looked at Bancor network or the protocol, and we definitely do think that the project is legit, great tech. For those who want to check out the review, go to our site, tokenmetrics.com. But I think, kind of as people mentioned earlier, right? DeFi is the wild, wild west, right? Kind of as you mentioned, you guys pretty much made AMM. Uniswap took your code, put it down, I guess just put ETH as a token, and it just blew up, right? So the space is very, very fascinating, but I'm very, very excited to see what you guys are doing with V2, because I think having that insurance where people don't really have impermanent loss, that's big. That's big. I'm actually surprised there isn't more buzz around this.
Yeah, I mean, I think people are just catching on right now, and doing sort of talks like this are a big help for us spreading awareness. And so, how has your experience been on Uniswap and SushiSwap? Have you felt firsthand the impact of impermanent loss on your holdings? I would imagine, especially in the sort of.
I mean, I haven't really looked at it. Pretty much, I just provide liquidity and don't
Yeah.
look at it for months. That's kind of
Yeah.
so I'm not so actively trading where
Yeah.
I need the funds right now. Right. Typically, I do it for my longer term investments or maybe even a longer term trade. So if I'm trading something for a month or two, I would just take a small part of my portfolio, let's say 10 or 20%, and provide liquidity just to kind of see how this works, right? So, but I would definitely not put all my funds into one LP.
But that's sort of when you're doing this on the hodl side, then the interesting thing is like, look, you said you remember I had whatever 100 ETH, and you put these 100 ETH in there, you let them sitting, and then say, oh well, I made a lot of fees, but suddenly because ETH went up, I only have 80 ETH left, and that's sort of what sucks on impermanent loss, right? That you sort of have this, okay, I made tons of fees, and the coin that I liked rallied, and because it rallied, the pool sold, and I have leftover, because remember you had 100 ETH to go in, and then you only have 90 or 80 left, and off a coin that rallied, and that I think that sucks.
But it also depends on the other side of the pair, right? If the other token goes up a lot, right? So I think most people who participate, they have to at least be very bullish on that pair.
Yeah, but that's especially if you're bullish, then you lose a lot, because if you're bullish, yeah, your token goes up, and yes, you're gonna make some money on the dollar value of the token. But if the token goes up massively, instead of having 100, you started with 100 of a token that went up massively, you then end up with 20 or 30 of a token that went up massively, which is still up in dollar terms, but way different from what it did, what it was in token terms. So because it keeps on selling on the upside. Yeah, this is what the algorithm does. Whenever the token goes up, it sells it, and so you miss, by definition. It's a well-known investment strategy that is sort of designed to make money on range trading, but it misses all the rallies. It is designed to miss the rallies. Yeah. So whenever one token goes up, you just sell it. It's like anti-hodl, essentially. The AMM is like the opposite of hodl. Yeah, after every move. Strategy. Yeah.
So Ian, I think what you're referring to is if both of the tokens go up together, or if one goes up and then the other
goes down, right?
Kind
of like a seesaw effect.
Oh, well, if one goes up with it, if they stay at that initial ratio, then yeah, you're going to be okay. But the chances of that happening are, pretty slim.
Yeah. Now to kind of add on to that, so what I typically do is I go to Zamperify, and there's an option there where it shows you the return on the liquidity pools and also the impermanent loss. Right, so I've been looking for pools where I'm still making more return and not really losing money. Right, so that's kind of been helpful. But to me, that's kind of been more of a side thing. I'm definitely not so advanced in terms of providing liquidity. But with that being said, let's get to the other questions as well.
Sure. Well, so hold on. I have to say, by the way, because you just gave us, Zamperify is launching their Bancor integration today. So very excited for that. Yes. So definitely keep an eye out for Bancor pools, and it'll be really interesting to see the sort of return metrics side by side with the other pools in the ecosystem.
Okay. All right. How are we doing on time? Maybe one last question to wrap up.
Yeah, sure.
Okay. Next question. Are there any plans to open source Bancor V2?
So it's fully open source currently. So And actually, this was an interesting part of Stefan's paper that he did. And so I'd love for him to chat. But when we were designing V2.1, it was actually when the whole sushi swap incident was happening. And we saw firsthand how easily AMM protocol could just get forked. And we believe that V2.1 is a little more resistant to forking. And Stefan, do you want to kind of jump in, because this was a sort of
I mean the point is that for a protocol like Uniswap or Sushi, the value is kind of in the code. Everyone can do the same thing, and if you have smart routing algorithms, essentially they're all the same. There seems to be a little bit of a stickiness of people routing trades to one pool, but they really shouldn't be doing it, and certainly not with the low gas fees. Now, Bancor can publish the entire code. You can run Bancor, but the value in Bancor is the community that provides impermanent loss insurance. And if you can't replicate this community, then you don't have Bancor. Yeah, you have the products, but without a Bancor community that is sitting behind there. It's like, look, if you're a big insurance company, yes, you can do all the same. You can build up another insurance company that has exactly the same contracts, everything the same, but you can't sell insurance contracts because you don't have the capital, you don't have the things in place. Just having people there, and you need the insurance network.
But but we've seen in DeFi where even communities can be stolen, right? When SushiSwap incentivized Uniswap LPs to migrate over by giving them tokens, they stole, I think, almost half of the liquidity.
Yeah, but the thing is, okay, but how did they do this? They gave them, so they stole the liquidity providers by giving them protocol tokens. But what are you going to give the protocol holders? Other protocol tokens? So yeah, you're trying to steal away the protocols, and then suddenly you have two protocol tokens. So you can't steal away a protocol token by giving other protocol tokens. So the only way that you can steal away Bancor, the only way that someone can make more money on this is by essentially having a system that earns more fees for the protocol providers, because you can't just, you could say, look, I give you, you come over here, you move your Bancor BNT token over there, and I give you more BNT. Well, you can't give them more BNT, but you can give them more token, but then you get dilution, and you just sort of get this, there's a limit to what you can do, yeah, because it's already a protocol token.
Okay, so to add on to that question that person asked, he's saying this is an important point since Bancor was already forked by Uniswap and lost market share. So basically he's saying, how does V2 kind of defend itself from what's been happening? I think they're called what, liquidity attacks now, or zombie attacks?
Vampire attacks.
Yeah, vampire attacks, right? So how does V2 kind of protect Bancor to make sure that it really kind of stays at the top?
Well, you know, what we've addressed on in this call is that the nature of Uniswap's fork, I mean, let's say that's the original vampire attack. That was that was replacing BNT with ETH, and actually putting Uniswap at a disadvantage, I think, in the long term, because they can't manage liquidity and provide an impermanent loss insurance or single asset exposure, which we're seeing are these key features for LPs using ETH. So for Uniswap to fork Bancor and offer the same LP features that are in Bancor v2.1, they would have to use Uni in each one of their pools and effectively rebuild the entire network around having a network token that's common in each pool. So I don't know.
So basically,
Stefan,
it's a difference in architecture that it's hard for them to kind of revert back.
You can't. Well, the architecture you can replicate, but you don't have the ecosystem. You need the people who are happy to have this token, who are happy to take this insurance risk. Yeah, and obviously if you get them, but what do you pay them with? This is always you can't just if you just give them tokens, you're paying them with their own money. These things work for a while because somehow it's the same thing like Tesla did a stock split. And then suddenly the market cap went up because somehow people didn't realize it's still the same company. There's absolutely no reason when you have a stock split that the company value should go up. For a real company, this is clear. For a token, this is somewhat less clear because there is no real company behind it. But ultimately, you need to make money. And the way to make money is to earn fees. Now you can incentivize people by give them protocol token, but whenever you give people protocol token, this means you take away from the old people who had protocol token. So that's a bit of a scheme that goes until it doesn't go anymore. Markets are a bit irrational in my view at the moment, but ultimately the way to gain in the business model like this is to have a sustainable, to build a sustainable business where the fee, that provides value to end customers, which in this case are, well, this is two-sided market. So the end customers are people who want to trade and people who want to get liquidity to work. And you allow both of them to earn money in the long run. And this is how you make money, as opposed to just giving free money away and then somehow things go up until they don't. Yeah.
Yeah. And I mean, let's just on a practical level, let's say someone came along and forked not only Bancor's code, but tried to fork the token community too, and said, we will give you more, we'll give more fees to BNT holders, or to, let's call them BNT2 holders. And we will we'll give more to them, but you have to, it's sort of a seesaw mechanism. It's a zero-sum game between token holders and liquidity providers. If you
end customers, there's three groups there, yeah. Right. But the fees need to be coming from somewhere and going from somewhere. Everything else is finished at one point.
So basically, you guys are saying there's no free lunch.
Yeah, essentially, yeah. Not for it, but it's also obviously markets can be irrational longer than you can remain liquid. That's the other part of this, and we're at the moment a bit more in the irrational phase. But
listen,
yeah,
there's no free lunch, and this is a phrase that's often used by people that are like, impermanent loss is a natural outcome of AMMs. It is just, it happens. You can't solve it. You can't do anything about it. This is sort of the Uniswap camp tends to think this, but effectively, I would very much agree with that statement on an individual liquidity pool, that you have to be taking it out of someone's pocket in order to be subsidizing the cost. But when you spread this risk across many different liquidity pools, such that the volatile pools where there's more divergence, you might have a higher cost of insurance and higher impermanent loss. But in the more stable pools, those will be wildly profitable because you don't have that much loss, you have more fees. So the V2.1's ability to diversify impermanent loss risk and spread it across multiple pools is going to be super fascinating, and really may drive a stake through the heart of this argument that you can't do anything about impermanent loss. And so we're very excited, and early indications on the system, it's been live for about a month, but early findings in sort of protocol health is that fees are covering impermanent loss on a network-wide basis. And as the liquidity in the system goes up and it attracts more trades and more fees, we'll actually hopefully see a deflationary force on BNT, such that the fees are exceeding the cost of impermanent loss insurance. And that'll be a beautiful thing to watch.
Absolutely. Absolutely. All right. Well, it's been a pleasure having both of you on, Nate and Stefan. Do you have any last words you want to share with our audience and community as we wrap up?
Thanks so much.
Thank you.
Thanks so much. I guess just if you want to get a feel for the system, go to bancor.network. There's no minimum to provide liquidity, so you can try it out. We love feedback, and we're at Bancor in Telegram and on Twitter, and we have a thriving and growing community that is obsessed with AMMs. And so if they interest you, we'd love for you to join us.
Right. And Stefan, any last words?
No, just thank you very much for having us on. And well, if you're interested in details, have a look at the paper and look me up. You have like, yeah, I mean, I'm always happy to discuss these kind of things because it's like a super fascinating topic. And yeah, we're going to see some very exciting stuff.
Stefan has a killer consultancy that has certainly been instrumental in our tokenomics design. So Topaz Blue, definitely check them out. Thank
you.
Projects.
Thank you, Nate.
All right. Well, thank you, everybody. Be sure to subscribe, like the video, share with your crypto family, friends. Anybody in crypto, I think, needs to watch this video because Bancor is definitely doing something very unique. So the fact that now we can have liquidity pools with just single token exposure and insurance is definitely big, right? And I think what you guys did initially with AMMs was also big. So definitely very excited to see what's going to happen. Thank you to everyone who asked questions via Twitter. Our team will DM all the people who asked questions, and we'll get your information to give out the free BNT tokens. That being said, as we like to say, the moon is not the limit, to the moon and beyond. Thank you, everybody. Goodbye.
Thanks.
Thank you. Bye.